Good afternoon. This is Laura Kreutzer, Assistant Managing Editor of the Private Equity Group and the Private Capital Markets Group of Dow Jones. And welcome to today's Spreecast on the Alternative Investment Fund Managers Directive, or as it's more commonly known, AIFMD. It's a raft of legislation that is passed in Europe, coming online this year. And today we have two fantastic guests, Greg Pusch, who is head of global compliance at HarbourVest Partners, a global private equity fund of funds and secondary and co-investment firm, among other things, headquartered in Boston. And we also have with us Molly Diggins, who is, you want to give us a wave, Molly? Who is the general counsel at Monument Group, which is a global placement agent. Unfortunately, Sally Gibson, our attorney from Debevoise and Plimpton, could not join us today. We had some technical difficulties, but we will try to set up a separate Spreecast with her to chat about this topic. So as we get into AIFMD, I think many of you out there maybe have heard of it. It's been around for a little while, but it's really sort of the rubber is meeting the road right now. And Greg, maybe you could give us just a little bit of a brief overview of this legislation and kind of what it means in Europe, and maybe a little bit about sort of the practical areas, the practical activities where it's having an impact for your firm.
Yeah,
Sorry, that's a lot to throw at you.
Do that. The interesting thing about this, from my perspective as an American, is it was Europe's reaction in part to the global financial crisis, and specifically as it relates to private funds. And it's interesting to me, all regulators choose a different path. This one, which of course is a multinational piece of legislation, regulates through marketing nominally. So it's it applies if you market these types of products in Europe. And we'll talk, I'm sure, later about reverse inquiry and other things where technically if you're not marketing, it doesn't apply. But having said that, the aim of the law clearly is to apply more regulatory safeguards to investors in these funds, notwithstanding being tied to marketing activities. And the upshot is that you can't market in these countries, with limited exceptions, unless you register the funds that you're marketing under the legislation, and that they are managed by an authorized manager that also is registered by one of the principal regulators in these countries. And beyond that, substantively, that you've met certain disclosure requirements and also limitations on how you manage these assets, and that you involve some new third parties, including specifically a depository, which is a whole other contractual arrangement separate from any kind of custodian or administrator. It's layered on top. So it's interesting that it comes at it from marketing, but really the goal, I think, substantively is something in between the relatively light regulation that exists in the United States still for private funds and mutual fund regulation, if you're comparing it to what's in the U.S., where these funds are actually registered, the manager is regulated. There are certain required disclosures. I think it remains to be seen whether or not the regulators, either uniformly or not, actually start substantively reviewing and commenting on the fund product.
So let's, Molly, let me ask you, as Monument, helps market a number of different funds around the world, and particularly in Europe. Tell me a little bit about, how this regulation is sort of influencing the way that your clients are looking at marketing private equity funds in Europe.
Well, it's sort of a challenge, obviously, to some extent, because if you are not otherwise registered as a manager under the AIFMD in the European Economic Area, then you really can't distribute unless you, as Greg mentioned, fall under one of the exemptions, which for the most part is really limited to reverse solicitation. So what we've seen and we specialize basically on mid-market managers, and what we've seen is that these mid-market managers have to make a decision. That is, whether they want to sort of really get more or new European-based investors, in which case they have to undertake certain compliance and other filing requirements, or do they feel like they can raise the fund without any European investors at all, or with perhaps just, in some cases, returning existing investors in a second fund?
So let me, and also too, please make sure you speak up so we can all hear, because I think there might be a little ambient noise out there. But so talk about reverse solicitation. Now, I've heard some firms use this, saying they're going to rely on reverse solicitation, which basically is they don't market to the European investors, as I understand it, but they are allowed to, if the European investors come to them and say, hey, I want to invest in your fund, then they're allowed to take that capital, and that's in compliance with the AIFMD regulations, but they just can't go out and actively market. So they're sort of just sitting by the phone, I guess, and waiting for the LPs to knock on their doors. But clearly there are probably some drawbacks to that as well. I'm wondering, like, some of the risks that might be associated with that, if either of you have some thoughts on that, because it seems like a lot of U.S. firms sort of are relying on this option.
Yeah, I don't know, Greg, if you have anything to add. Can you hear me a little better now?
Yeah, I can now. Yeah.
Okay, great. So I think that reverse solicitation, if you've got a number of investors that you'd like to reach out to, or have them reach out to you, that can be a risky sort of course of way of proceeding, because the more investors you have, the more likely you are to draw the attention of the regulator. And the fewer investors you have, I think it's easier to be able to establish in each given case a real pattern of reverse solicitation. And reverse solicitation can only be established based on an entire course of conduct with respect to that investor. So did the investor really initiate this sort of conversation? And that can be really hard sometimes, unless you've got, for example, an existing investor with whom you're continuing to provide information, continuing to provide updates at meetings, things like that. So it's difficult if you really want to reach out to a number of investors.
I would just add, I think that's right. And the other variables, it's going to depend on the country. So if you're trying to make a risk judgment about whether that's a viable approach, there are some countries that only deem marketing to begin occurring when you've actually delivered the final documents, and there might be a little bit more interpretive area there for initiating a chain of events, whereas in other countries it seems pretty clear are going to be much more strict, and if you're going to do it, as Molly says, if you have any scale to your activities, it seems somewhat problematic, especially since the regulators must be well aware that if they don't enforce it, at least to some extent, it kind of it would have a knock-on effect to the viability of the regulation as a whole.
And I understand that the UK is sort of one of the more sort of friendlier jurisdictions for non-EU firms to market, or at least clearer is kind of what I've heard. Is that true? What are the more complicated countries?
I don't know that I want to characterize countries, but I would say we certainly, for other reasons as well, which I can talk about later, have chosen the UK as our primary regulator. So our new manager is in the UK, and our funds are Scottish funds, but nevertheless, you obtain the passport to market in the rest of Europe, and the view of a regulator in a particular country is still relevant, and I think it's probably also relevant what type of client you're really talking about, who the LP really is. Is it an ultra-sophisticated, almost quasi-sovereign or governmental entity, or is it a relatively small pension plan? And I think all that's relevant. I think a lot of U.S. managers, when I talk to my colleagues, this has been coming for a long time, but it's also been unclear for a long time how it's various aspects of it are still somewhat unclear. It's unclear how expensive it's going to be in the long run. And if you're not in a fundraising cycle where you've had to go into Europe on a large scale within the last year or two, or even now, say starting 6 months ago forward, you can see the instinct might be to hold back and see how this exception of reverse inquiry plays out in practice.
Hmm. What about now, Greg? HarbourVest kind of went through the pain and the brain damage to actually register as an alternative investment fund manager or an AIFM. I'm wondering if, because this is one option, like I guess reverse solicitation would be one, but you can actually register as an alternative investment fund manager, which is what HarbourVest did, was one of the earliest U.S. firms to do so. I'm just curious, can you walk us through a little bit, like what did that entail? Why did you decide to take that path?
Sure. Well, taking the why first, HarbourVest is a very large fund of funds manager. We have a large European client base. And we have a number of fund programs that we're usually offering at one time. So back to my earlier comment, I'm not sure we have an option to effectively service that client base, current and future clients, without taking it. We took a close look at this starting late 2012. And our commitment to Europe led us to want to be able to essentially market freely, or as freely as you can, within the context of private funds. So that was kind of at the end of the day when all was said and done. And then we did think a little bit about the fact that it clearly was going to be the case, and it has, I think, turned out to be the case, that the regulators would be very, they would be very, very busy when this first came out. We didn't want to be at the back of the line, or I should say the queue, in terms of an application if we did move forward. So we went ahead and we filed an application with the FCA in early August of 2013, which is the earliest you could do it in our regulatory status, and didn't actually receive authorization until last April. So it was a long process. You register your manager. In our case, we didn't register our entire firm. We created a new parallel manager in London to an entity we already had there. And we created parallel funds alongside our existing funds. So we're rolling forward all of our new major fund programs in parallel, where there might be 4 Cayman or Delaware funds, including and then feeder funds as well. But then in parallel, there'll be 4 Scottish, in our case, we're using Scottish limited partnerships alongside that are geared towards the European investors. So it's an all-in commitment to this. It was expensive. It was a long process. It was, I have to say, they're fairly smooth from the point of view of the FCA, just take time. But what we haven't done is sort of the middle course, I think, between doing nothing and relying on reverse inquiry and doing this. We haven't registered our firms, our entire firm, and we also haven't registered our main funds in Europe. So the European funds have been kept separate from more Cayman programs that are offered to the rest of the world, although in theory someone in another country could buy a European fund.
You mentioned that it's expensive. I'm curious, are we talking like tens of thousands of dollars? Is this hundreds of thousands of dollars? What's the cost range typically, or at least that this kind of thing requires
I mean, it's probably
to do this?
It's got to be a little hard to generalize. And it depends how you go about it. I would say it's more in the hundreds of thousands of dollars, though. It's certainly not the tens of hundreds of dollars. And some of that is an expense that should appropriately be borne by the management company. Some of it is expense. As you set up the new parallel funds, those, of course, are fund expenses. But it is a significant expense. It's a large filing, and there's quite a bit of review back and forth. And I think that there's the expense of finding, of selecting, and engaging a depository, which is this new third party I mentioned. And I think as well, it remains to be seen whether or not this turns into a model where the regulator is commenting actively on the fund, the LPAs and the PPMs of the fund. Our experience hasn't been the case so far, but that could happen as time goes on and resources that the regulators free up, and that will tend to make it a more expensive process.
Molly, let me ask you. You work with a lot of mid-market and smaller firms. When I hear hundreds of thousands of dollars, that's pretty costly for sort of a smaller firm. Do you see some of these smaller firms just writing off Europe and saying, I'm not going to, it's too much brain damage for me, I'm not going to market in Europe?
Well, we have, but I want to back up just a little bit because
Sure.
I want to point out that there's something sort of in between full-fledged AIFM registration, which HarbourVest has undertaken, and reverse solicitation. And that is what we call the Article 42 light compliance requirements, essentially. And what that means is that until 2000, well, as it's written now, as the directive is written now, until 2018, non-EEA based managers can market into Europe on a state-by-state basis if they comply with each of those states, what we call Article 42 compliance requirements. And basically, it's sort of an enhanced private placement regime. So they could still sort of do the private placement, but they have to do a limited number of filings in the state, or a notice requirement that they're going to market this fund, et cetera. And that we've seen a number of our clients say, you know what, that's worth that to me, because it's not the big undertaking and the resource doesn't eat up all that time and money and expense. It eats up some, but it's worth it because those investors and the possibility for real assets based in Europe is great, and it's worth it for them.
But that's, are they having conversations though yet about what happens after 2018? Because that's only up through 2018, right?
Yeah, so I think, there's sort of a short and long-term approach. And I think the short-term approach is, let's see what happens, especially those that really do want to raise some money in Europe, and they're willing to undertake, for example, the Article 42 compliance requirements. And I think they're saying, well, let's do this now and see how this sort of pans out. And if we can or have to register as a full-fledged manager in 2018, at least we'll have some flavor for what's going to be required ultimately, because some of the requirements under Article 42 are the same as under the full-fledged manager requirements. Mm. And then we don't know if, in fact, the directive will be adopted, or that part of the directive will be adopted that would allow for non-EEA managers, or that basically what would happen in 2018 is the entire private placement regime in every European country is supposed to go away, in which case Article 42 compliance goes away, and the only way to market is to become a full-fledged manager. But I'm not sure that, in fact, all of the private placement regimes are going to go away in 2018, in which case Article 42 compliance light will be extended.
I think
that's interesting.
Absolutely a valid approach, and the question is, the one bit of compromise there is that to the extent, even under that light regime, you're subject to things like remuneration disclosure and other aspects of AIFMD. You've got to be willing to do that for your entire firm if you don't create a separate manager. And I would just say on your first point, I think it may be the case. I mean, it's interesting. If you take a very successful venture firm in the U.S. that's already oversubscribed out in California, you might say, you can see them saying, well, we just aren't going to, we're already oversubscribed. You may not want to deal with this at all. And that remains to be seen. Of course, that is a bit of an opportunity for HarbourVest, because as a fund funds manager, that's our way to offer European investors access to those managers.
Have you heard some conversations? I know HarbourVest has some a pretty broad network of some pretty deep venture relationships there.
Yeah, it remains to be seen, I think.
Okay. What about now? One last thing to get into before we wrap this up. But I'm also seeing some firms, like one recently was Royalton Partners in Luxembourg. Some firms that are offering kind of an outsourced solution, basically outsourced compliance, where they will be kind of the outsourced AIFM, and it seems like a number of these firms themselves have already gotten AIFM licenses, and they're trying to market these services to non-European firms. And I'm curious, Molly, any of your clients looking into that, or it seems like it's a relatively new phenomenon, but I'm curious sort of what kind of reception it's getting out there in the marketplace, that strategy.
Yeah, well, unfortunately, all this is playing out real time. So this is a new service in the sense that it's an AIFM related service, but it's an old kind of service in the sense that managers previously registered in Luxembourg have provided this sort of outsourced, ManCo, management company service in the context of these even UCITS and other types of funds. Now they're doing it basically for non-EEA based managers who want to market under the directive but don't want to become fully registered. And so it remains to be seen whether this is going to, really take flight from a regulatory perspective. But I don't see why in one instance, for example, under the existing UCITS and other regime, it would, and not in this one. And we are looking at it. We're looking at it from a monument group perspective, even to perhaps, set up some sort of joint sort of venture with one of these and be able to offer our clients who don't have, a place of business or feet on the ground in Europe, an easy way, in essence, to set something up in Europe and be able to obtain a passport.
One last question, and then I think if and we encourage anyone who's watching, if you have questions, definitely lob them in. I know it's a pretty complicated topic, but one thing I am kind of curious about is to what extent you're starting to see pressure from the European investors, the limited partners in Europe, starting to differentiate maybe between firms that are AIFMs and ones that aren't. I'm just curious whether you're seeing any pressure from the European institutions themselves on GPs to kind of make sure they're complying or become AIFMs.
I think it's early days. I'll tell you, our experience has been mixed. It's certainly a regular question on RFPs and other interactions like that. And there have even, on the one hand, been cases where we've been talking to people about a separate account or a fund of one mandate, which would not fall within the AIFMD, but nevertheless that seems important to them. So to the extent it goes that way and it's viewed as sort of a seal of approval, or at least something to validate that firms maybe committed to Europe, but also just got some regulatory oversight. That could happen, but I have to tell you, honestly, candidly, on the other hand, there are a lot of large institutional clients and prospects we talk to that don't seem to really be that focused on it. But maybe that's because they don't view it as their issue, to tell you the truth. I think the risk of a reverse inquiry or something like that gone wrong is probably mostly on the manager, not the investor.
Any last thing to add, Molly, on that score?
We've seen the same. For example, a lot of the limited partners that our guys in Europe will talk to our pension funds, et cetera. And those are more and more requiring that the managers they invest in are compliant with the AIFMD, or if not, with a similar, equivalent regime. So for European-based managers, certainly they're requiring the AIFMD compliance and registration. For non-EEA-based managers, I think they at least like to see, or will like to see, ultimately some sort of Article 42 type of compliance.
Well, thank you so much. I think we're at about at our time, and I would like to thank both of you, Greg Pusch from HarbourVest Partners and Molly Diggins from the Monument Group. Thank you so much for joining us. And this is Laura Kreutzer, Assistant Managing Editor of Private Equity here at Dow Jones and Private Equity Beat, saying until next time. Thank you guys so much.
Thank you.